Track Private Wealth Senior Portfolio Strategist, David Dietz, and the Fitz-Gerald Group Principal, Keith Fitz-Gerald. Great to have you both. David, let me start with you here. Again, this sell-off, light volume, do we get worried? Does this portend something for a bad January?
You know, I can even argue that this is kind of healthy. We have seen, you know, this is the second year in a row, more than 20%. And the group of stocks that are being hit hard today, these are the stocks that are up anywhere from 20 to well over 100%. In the case of NVIDIA, I mean, at some point, people do need to take some profits. We thought it was going to be January 2, so people could defer the taxes. Yeah. And of course, the money is rotating into some of the unloved areas of the market. For him, Lamb Weston, who knew? Consumer staple stocks are all up. Why have they been down all year? At least they're getting some love today.
Keith, desperate for your thoughts on Apple. I talked in the open about trying to get up to $4 trillion. Do you think that Apple is still underrated, underappreciated by this market?
No question in my mind that's the case. It may be one of the most significantly underrated. $4 trillion with a T. I can't believe it. I mean, we talked about this a year ago and said this is probably going to be the one that wins. I think they're just getting going, Taylor. People just don't understand how dominant this ecosphere is, how many people are going to access some form of AI through Apple devices, how pervasive Apple devices are in our lives. This is a horse race that is just getting started.
So, David, talk to me more about that. When we think about tech leading the sell-off, Apple's in there, Amazon's in there, Microsoft's in there. How much of this are concerns a little bit about valuation, or do you agree with Keith that these are companies that are still sort of relatively underappreciated by the market?
Well, certainly when you look at earnings for next year, they're going to be outstanding. It's going to be led by the tech group. So at least to the extent they're overvalued for a good reason because these earnings are going to be so good. Now, I would, as much as I respect Keith over there, I'm going to push back a little bit on Apple insofar as historically, that stock is traded with a mid-teens multiple. Now it's well into the 30s, but the growth rate isn't that much picked up. Now, I love the idea of AI in my iPhone. How much more are people willing to pay for iPhones as a result?
I am not. I refuse. Keith, I don't know. Are you shelling out another $1,000 to get Apple Intelligence?
No, but I bought more Apple stock today, and I just got a new iPhone, as a matter of fact. So,
all right. So on that note, talk to us, because we're going to give that one to you. Are you worried, sort of going through your notes, one of the worries I was seeing is just the concentration of this market. We've talked about the equal weight, of course, not keeping up with the market cap weight of the S&P 500. Is there a concentration risk with big tech?
Well, lots of people think they are, but they don't understand their history very well. If we go back to the 1950s, you had three companies making up nearly 30% of the S&P 500 by themselves. 1960, AT&T took up, I think it's 13, 14, 15%, all by itself. So we're well within historical norms. The other thing that people talk about when it comes to concentration is, oh my gosh, it's just these companies. What they don't understand is just these companies have global operations, diverse revenue streams. Again, you know, if it's Tesla, it's robotics, it's this, it's that, it's the other thing. Apple, same thing. It's devices, it's phones, it's licensing, billions of devices. So the companies themselves are, in fact, spread out, even though the name appears concentrated.
Well, and they're the ones pulling in free cash flow of billions and billions and billions of dollars. David, talk to me, though, about concentration risk and the way that it adds to volatility, especially as I'm trying to plan volatility for next year.
Our work shows historically, as concentration goes up in the market, particularly to the extent it's the one pulling up the value, that's followed by some weakness. And Keith is absolutely right. There's always been a few companies near the top. The problem is if you constantly reloaded your portfolio into those big companies, you actually underperform the overall market. So usually the biggest guys have the toughest time growing from there. It's usually those mid caps and small caps that ultimately can sustain that earnings growth.
Keith, talk to me. Another stock pick that you have is Palantir. And I think coming into this year, this was one of the most, in terms of underrated by the market, Palantir. It's one of the top performers. It's been added to multiple indices. This is a company that I think has defied all logic at almost $80 a share. How should I be thinking about the massive run that Palantir has had and future growth opportunities for 25?
Well, it depends on your perspective. You know, we were very lucky to get that one right. We could have easily been wrong. But again, here's a case of another company that is integral to our national defense, integral to AI. There is no competitor doing what it does. Customers are running to it, not away from it. And you're talking about growing 50, 60, 70, 100% in some revenue use cases. So Again, I'm holding on. I bought more of that one today too. So I think we're in for the long run. I think we're looking at a spectacular run from here. And I'm very excited to be a shareholder.
I'm going to so push back on you insofar as valuations do matter. This is the company that should earn about 6 cents on an $80 stock. Price to sales close to 100. Now, they're making great headway into the defense business, but isn't Mr. Trump the president's going to end wars, not start wars? And of course, they want to sell to the government in other ways, but aren't the Doge team going to reduce spending? And finally, of course, they want to be, the web face, the AI web face. But guess what? I wouldn't want to compete against Microsoft, Alphabet, Apple. Those companies are not going to be easy. Be careful what you pay, Keith.
Tell you what, here, I'm going to push right back on your pushback, and I love you, man. But return to scale is the deal. If you're talking about manufacturing, then accounting reflects that. PEs are accurate, so is free cash flow and valuation. But if you're talking about return on scale, PEs don't matter because what's happening is the digital spend is expense. Other stuff is amortized. They're very different equations.
David, pivot with me as well. I'm looking at some of your stock picks. CVS, Nestle. Make the case for these.
Yeah, absolutely. So CVS is at the heart of healthcare, and after technology, healthcare is going to have the greatest earnings growth next year. They've got the PBM, the portfolio, the pharmacy benefit manager. They've got #1 in terms of retail outlets for drugs. Of course, they have Aetna. Now, of course, the opportunity is because we may almost have Trump healthcare, right? But when we look back in history, Hillary healthcare, Obama healthcare, all these healthcare stocks went down, but it's easy to throw rocks at the system. It's hard to redo it. Come back to CVS with that 6% dividend, 8 times earnings. It's going to be a winner.
Keith, finally, last thoughts for you as you looked at 2025, Federal Reserve, bond yields at 4.5%, deflationary forces with Doge coming in. Do all of those make you worried about the market?
Well, here's the thing. I wouldn't be very good at my job if I worried about a lot of that stuff. I think they're an opportunity. The question is how you address them. To David's point, and I love you, man. I love the way you handle this stuff. If you're looking at the hot stuff, that's not the right question. If you're looking at what's going to be there, when you're going to need it, that's the thought process that I'm applying to this day.
Well, this was really fun. I loved having you both. I learned a lot. I got to laugh a little bit. I'm still not buying a $1,000 iPhone, but Keith, I love that you're buying the stock. David Dietz, Keith Fitz-Gerald, really great to have you both. I'm still on my iPhone 6. Awesome. Happy New Year to you both.